In August 2023, the BRICS nations, representing 42% of the world's population, announced plans to challenge dollar dominance. By 2024, central banks had dumped U.S. treasuries at the fastest pace in decades. China and Saudi Arabia conducted oil trades in yuan, not dollars. Russia abandoned the dollar entirely. But here's what nobody's telling you. This isn't the first time the world's reserve currency has collapsed. And when it happens, everything changes. Your savings, your purchasing power, the global balance of power itself. This is the story of how reserve currencies die and what comes next. To understand where we're going, you need to understand how we got here. In July 1944, delegates from 44 nations gathered at Bretton Woods, New Hampshire, while World War II still raged. They had one mission: redesign the global financial system. Europe lay in ruins. The British Empire and the British pound were bankrupt from war spending. America emerged from the war holding 2/3 of the world's gold reserves and half of global manufacturing capacity. The choice was obvious. The US dollar would become the world's reserve currency, backed by gold at $35 per ounce. Here's what that meant in practice. If Brazil wanted to buy oil from Saudi Arabia, they'd use dollars. If Japan wanted to build up reserves, they'd hold US Treasury bonds. The dollar became the middleman in virtually every international transaction. And this gave America an extraordinary privilege. When you control the reserve currency, you can print money to pay your debts. You can run massive deficits because foreign countries need to hold your currency to trade. It's called Exorbitant Privilege, a term coined by French Finance Minister Valéry Giscard d'Estaing in the 1960s, when he realized America was essentially getting free loans from the entire world. But throughout history, every reserve currency eventually falls. The Spanish real, the Dutch guilder, the British pound. Each dominated global trade for roughly 80 to 110 years before losing its status. The dollar has been the dominant reserve currency for 80 years. And the warning signs? They started appearing decades ago. August 15, 1971. President Richard Nixon appears on national television with an announcement that shocks the financial world. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold. This was the Nixon Shock, the moment the dollar stopped being backed by gold and became what's called fiat currency, money backed by nothing but government decree and trust. Most Americans didn't understand what happened, but French President Georges Pompidou did. He called it the monetary crime of the century. Why? Because Nixon had just defaulted on America's promise. Foreign governments holding dollars could no longer exchange them for gold. Their reserves had become paper promises. Without gold backing, America could print unlimited dollars. And they did. The national debt, which had been relatively contained, began its exponential climb. From $398 billion in 1971 to over $34 trillion today. But the dollar remained dominant. Why? Because of what happened next. In 1974, Secretary of State Henry Kissinger struck a deal with Saudi Arabia. The terms were simple. Saudi Arabia would sell oil exclusively in US dollars. And in exchange, America would provide military protection and arms. This created the Petrodollar system. Suddenly, every country on Earth needed dollars not just for general trade, but for the most essential commodity in the industrial world: energy. If you wanted oil, you needed dollars. This locked in dollar demand for another 50 years. But by the 2000s, the cracks were widening. In 1999, the European Union launched the euro, the first legitimate challenger to dollar dominance in decades. By 2003, the euro accounted for 20% of global reserves. Then came something more subtle, but more dangerous. America began running unprecedented twin deficits, budget deficits and trade deficits. The U.S. imported far more than it exported, paying for the difference by printing dollars. Economist Warren Buffett warned in 2003, the U.S. trade deficit is a bigger threat to the domestic economy than either the federal budget deficit or consumer debt. Countries started to notice they were accumulating massive dollar reserves, dollars that were losing purchasing power as America printed more. China became America's banker, holding over $1 trillion in U.S. treasuries by 2008. Russia held hundreds of billions. Japan held even more. But what happens when the banker loses confidence in the borrower? When Lehman Brothers collapsed in September 2008, the Federal Reserve did something unprecedented. It printed $4.5 trillion through quantitative easing to save the financial system. To foreign nations watching, this was a warning. The U.S. had just demonstrated it would print unlimited dollars to solve its problems. And every dollar printed diluted the value of their reserves. China's central bank governor Zhou Xiuying published a paper in 2009 calling for a super sovereign reserve currency to replace the dollar. Russia began slowly reducing its treasury holdings, but the dollar still held. The 2008 crisis actually strengthened it temporarily in panic. Global investors fled to dollars as a safe haven. Yet something fundamental had changed. Trust was eroding. In 2014, when Russia annexed Crimea, the United States deployed a new weapon: financial sanctions. The U.S. cut Russian banks off from the SWIFT payment system, essentially expelling them from the dollar-based global financial network. This sent shockwaves through Beijing, Tehran, and every other capital that had tense relations with Washington. The message was clear. The dollar wasn't just a currency. It was a weapon. And that's when the acceleration began. China launched the Cross-Border Interbank Payment System, or CIPS. In 2015, their alternative to SWIFT, Russia began accumulating gold at record rates, dumping dollars. In 2016, the yuan joined the IMF's special drawing rights basket of elite reserve currencies. Then came the point of no return. When Russia invaded Ukraine in February 2022, the West unleashed the most severe financial sanctions in history. Over $300 billion in Russian central bank reserves were frozen. Russian banks were ejected from SWIFT. The ruble collapsed initially, then recovered, as Russia demanded payment for oil and gas in rubles, not dollars. Every central bank in the world was watching, and they reached the same conclusion. Holding dollars meant your reserves could be confiscated at Washington's discretion. The dollar's exorbitant privilege had become exorbitant vulnerability. What started as whispers became a roar. In August 2023, the BRICS nations Brazil, Russia, India, China, and South Africa held a summit in Johannesburg. The agenda: challenging dollar dominance. They announced plans to trade in local currencies and discussed creating a BRICS currency backed by gold and commodities. Then came the expansion. 6 new nations joined BRICS in 2024: Saudi Arabia, UAE, Iran, Egypt, Ethiopia, and Argentina. This wasn't just an economic bloc anymore. This was 46% of global population and 37% of global GDP actively working to bypass the dollar. In March 2024, Saudi Arabia announced it would not renew its 50-year Petrodollar Agreement with the United States. For the first time since 1974, Saudi oil would be sold in multiple currencies: yuan, euros, rubles. This was the moment. If oil no longer required dollars, one of the fundamental pillars of dollar demand had collapsed. China seized the opportunity. By mid-2024, over 25% of Chinese international trade was conducted in yuan, up from just 3% in 2015. The Shanghai Oil Futures Exchange, where oil trades in yuan, saw volume surge. Central banks began quietly diversifying, not loudly announcing Dedollarization that would crash their own reserves, but steadily, methodically shifting. Gold purchases hit record levels. Central banks bought 1,136 tons of gold in 2022 the highest in 55 years. They bought even more in 2023 and 2024. Poland repatriated its gold from the New York Fed. Germany did the same. Countries wanted physical assets they controlled, not promises from Washington. For ordinary Americans, the consequences are already materializing. As foreign demand for dollars weakens, the currency's value relative to other currencies declines. This shows up as inflation, the rising cost of imported goods. That $50,000 Japanese car? Now $65,000. European vacation? Suddenly 30% more expensive. Your iPhone, your clothing, your coffee, anything imported becomes more costly as the dollar weakens. But it's not a crash. Not yet. It's a slow, grinding decline. Death by 1,000 cuts. In response, the Federal Reserve faces an impossible choice. Raise interest rates to defend the dollar and crash the economy under $34 trillion in debt. Or keep rates low and watch the dollar's purchasing power evaporate. They're trapped, and the world knows it. We're witnessing in real time what happened to the British pound between 1918 and 1945. Not a single dramatic collapse, but a steady, irreversible decline as the world found alternatives. The question is no longer, will the dollar lose reserve status? The question is, what replaces it? History teaches us that reserve currency transitions are measured in decades, not days. When the British pound lost its status, it didn't happen overnight. The pound remained important for years after Britain could no longer back it with economic might. The transition took from roughly 1918 to 1945, nearly 30 years of gradual decline. We're not moving to a new single reserve currency. We're moving to a multipolar currency world where multiple currencies share reserve status. The euro already accounts for 20% of global reserves. The yuan is at 3% and rising. Gold is making a comeback not as direct currency backing, but as the ultimate neutral reserve asset that no government controls. Then there's the wild card, central bank digital currencies, or CBDCs. Over 130 countries are exploring or piloting digital versions of their currencies. China's digital yuan is already in use by over 260 million people. These aren't cryptocurrencies like Bitcoin. These are government-issued digital currencies that could bypass the dollar-based banking system entirely. Imagine China and Brazil trading directly in digital currencies, settled instantly, with no dollars involved. This collapse follows the same pattern as every previous reserve currency transition. Phase 1. Complacency. The dollar is invincible. It's different this time. That was the 1970s through 2000. Phase 2. Excess. Massive deficits, unlimited printing, weaponization of currency status. 2001 to 2014. Phase 3. Warning. Small cracks appear. Experts warn. Mainstream ignores. 2014 to 2020. Phase 4. Acceleration. Problems spread faster than expected. Alternatives emerge. 2020 to 2023. Phase 5. Where we are now. Realization hits. Shift becomes undeniable but gradual. 2023 to present. Phase 6. The future. System transitions. Old reserve currency remains important but loses exorbitant privilege. 2025 to 2040 and beyond. What many people don't realize is that reserve currency status funded America's global military presence. Those 750 military bases in 80 countries? Paid for with printed dollars that foreign nations had to accept. As the dollar declines, America's ability to project power globally declines with it. Not because of military weakness, but because of financial constraint. The post-World War II, American-led global order was built on dollar dominance. As that fades, so does America's unilateral ability to shape global affairs. Understanding this crisis teaches us that currency isn't permanent. It's a social agreement, and agreements change. For individuals, this means rethinking what savings means. Holding only dollars means holding a depreciating asset. Diversification becomes critical, not just across stocks and bonds, but across currencies, hard assets, and inflation-protected securities. The decline of a reserve currency doesn't mean economic apocalypse. Britain survived the pound's decline, but it does mean fundamental restructuring of purchasing power and global influence. The parallels between the pound's decline and the dollar's current trajectory are striking. In the 1960s, Britain ran persistent deficits while trying to maintain global military commitments. The pound was overvalued. Other nations began demanding gold for their pounds. Britain's response? Devaluation in 1967, followed by years of decline. The patterns are eerily similar. Warning sign number 1. The debt spiral. U.S. national debt has crossed 122% of GDP, level typically associated with crisis in other nations. Interest payments on this debt now exceed defense spending. At current rates, by 2030, interest payments will consume 20% of all federal revenue. This is unsustainable, and everyone knows it. Warning sign number 2, the trust deficit. Trust in the dollar isn't about economics alone. It's about confidence in American institutions. The regional banking crisis of 2023, political dysfunction in Washington, and the weaponization of the financial system have all eroded that trust. When Saudi Arabia diversifies away from dollars, when France settles LNG trades in yuan, when Brazil and China bypass dollars entirely, these aren't economic decisions. They're trust decisions. Warning sign number 3. The alternatives are ready. For the first time in history, viable alternatives to the dollar system exist simultaneously. China's CIPS payment system, Russia's SPFS system, cryptocurrency settlement layers, central bank digital currencies, and gold-backed trade agreements. The infrastructure for a post-dollar world is already built. The dollar decline taught us to look for structural imbalances masked by temporary stability. Today, those imbalances are everywhere. Record debt, declining foreign treasury purchases, rising dedollarization, weakening petrodollar system. Is this pattern repeating? History suggests we should be paying very close attention. This isn't about predicting the exact date of collapse. It's about recognizing we're in the transition phase right now. The question isn't whether change is coming. It's whether you're prepared for what that change means. The death of a reserve currency isn't an explosion, it's erosion. It's happening right now, in central bank meetings, in trade agreements, in the quiet diversification of reserves across the globe. The dollar won't disappear, but its exorbitant privilege is ending. And that changes everything from grocery prices to geopolitical power, from your investment returns to America's role in the world. The question is not, will this happen again? But are we prepared for what comes next? What do you think will replace the dollar? Gold? Digital yuan? A basket of currencies? Drop your thoughts in the comments below. I read every single one.